Welcome to the daily update, where I'll go over the action in the market for Tuesday, March 5th, and then we'll see how things look for Wednesday, March 6th. We had a fairly significant decline in Tuesday's session. Right now, it looks like it was profit taking, just a little bit of a pullback, but we'll be watching things day after day to see if this develops into something more substantial if we continue to go down. But for right now, the market seems to be hanging in there. We did drop below that short-term trend line that I've been trying to point out, but we're still above the 20-period moving average. That's going to be the next line in the sand to see what the market does going forward. So let's go back and talk about what happened. Right at the open, we had a gap lower open below S2. Now, Monday's session was pretty narrow in its range from high to low. And so that meant that we were hitting S3, S4 in Tuesday's session because it looked like a pretty big pronounced move compared to what we saw on Monday. So we gapped below S2 at 51.13. We went right below that 51.11 level. It hasn't really established itself as support, at least yet. And we fell below S3 at 5,091. So we also dropped below 5,100. Prices chopped below, let me try that again. Prices chopped below S3 and then ended up falling below S4 at 5,068. We did find support at around the 5,057 level. We climbed back up a bit going into the close, and we closed just under 5,080. We were down 1.02%, a little bit more of a substantial move than what we've seen lately, and we were above average with volume. We are still positive with our technicals. It really wasn't about inflation or interest rates in Tuesday's session. The ISM report that came out was fairly market friendly. The futures were negative before we even opened up. We ended up gapping lower. A lot of folks were thinking, okay, I've had a good run here. I'm just going to go ahead and get out. And that just led to more and more selling. We do want to keep an eye on what's happening geopolitically. Some comments that we can make for right now. Now, this could always develop or morph into something more severe, but for right now, it looks like profit taking after folks were making pretty sizable gains, especially if you go back to the October lows. The mega caps underperformed. They're the ones that have been performing better. And so those are the ones that got hit kind of hard. We're seeing some weakness in a few of them, and I have some charts to show you. We just have the stochastics being extreme positive in the short term right now. Everything else was wiped off in Tuesday's session. Intermediate term, we're still looking at the oscillators where they had been crossing above their moving averages, but they were extreme positive. Now they're starting to cross below their moving averages. The Sean trend meter did decline, but it's still extreme. And then this is a longer type of indicator that we use. It's a 10-period new high, new low study. It takes longer for that to move, and it's still extreme positive. In the long term, we're still looking extreme with our 150 and 200-period simple moving averages. And believe it or not, the Stoch RSI, one of our touchier indicators, it's already looking extreme negative. We're still dealing with this basic scenario that it looks like the Fed is done raising rates. They're probably going to cut rates in 2024. We're not really sure when. That's what the market is trying to figure out. The dollar was down and interest rates were also down. We closed at 4.14% for the 10-year yield. Now, this could have given support to stocks, both with the dollar being down and interest rates down, but that didn't seem to help in Tuesday's session. The yield curves that we follow are still inverted. We did come down when we're looking at sentiment. We had been at 79. We dropped below that 75 level, and we closed at 74 there. So we're starting to wear off some of this extreme optimism that we've been seeing. Our trend is still positive for right now. The green line is coming down below 40, and I'll show you that chart. Now the ADX is back to weakening, where it was looking like it was getting stronger. It was starting to come above the moving average. Now that it's picking up a potential change in how things are acting, now the ADX is starting to look weak, but it's still above 20. So we're still in a trending environment. With the down day, we are negative with bias. And I've changed our momentum from mixed to positive still. More than just one day, I think, needs to feed into this before we turn a little bit more negative over the last 2, 3, 4, 5 trading sessions. The economic reports that came out, I just have the numbers here to show you. We had the S&P Global U.S. Services PMI come out. The takeaway from this is it's above 50, so it's showing some growth there. When it's 50 and above, that shows expansion. We came in at 52.3. Last time it was at 52.5. Factory orders were down more than expected. They had expected them to be down 2.5%. They were down 3.6%. Last time they were down 0.3%. ISM non-manufacturing. This was the big one. It actually came in a little weaker than expected. They thought it was going to come in at 52.7. It came in at 52.6. Last time it came in at 53.4. Here's some charts. This is showing factory orders, how they are declining and they're actually going negative on a year-over-year basis. A little bit of economic weakness there. On a year-over-year basis, the durable goods orders did go up. So they're buying these products that tend to last longer. Then non-durable goods saw a decline and were still below zero there. Non-defense capital goods did see a decline, but we're still looking positive. And then here's the ISM, where we look at the total. That's the blue line, where we did see a decline, but we're still above 50. So we are showing some growth in the economy, but it did weaken from the previous reading, where prices are also falling down. See, this could have been a friendly report for the market, but they just decided to take profits on Tuesday. Just one chart to show you here. This is looking out with earnings per share estimates going forward, put out by Goldman Sachs, where they're still looking rosy. When we look off into the future, this tends to justify stock prices going higher because ultimately it's about earnings. Then I showed this chart in yesterday's video. I just want to bring it up since we had a down day. We've dropped a little more than 1% right now. The pullbacks that we would normally see would be anywhere from 5% to just under 10%. If that ends up happening, it can take us about 1.5 months to get back. I'll keep this chart around and bring it up kind of on an as-needed basis. Here's our intraday chart, where we ended up closing down in Monday's session on some weakness, but then we really gapped lower below S2. We went down below S3. We ultimately went down below S4. We found some support here and then bounced up a little bit going into the close. Here's our intraday chart, where the futures really started to go negative right after the market closed. Then it just continued with that in the pre-market session. Here's the cash session, and we're seeing a little bit of a bounce here. And for right now, the futures are up slightly in the initial overnight session. We did see growth pull back where the blue line is underneath the red line. They were both down on the day when we look at them independently. But when we look at the ratio, we saw a real drop off in growth. It got hammered pretty hard. And that's the mega caps. That's the Magnificent Seven and a lot of the companies that have really been doing well lately. We saw a little bit of a bounce later in the day, but we wanted to see a continuation of this ratio going up. Now it's starting to show some weakness. Here's our end of day chart where growth was down a lot more. It was down 1.62% when you compare it to value for the large caps. It was also down for the mid caps and down more for the small caps. So anything associated with growth did not have a good day on Tuesday. We're also pulling back with our end of day chart with the small cap growth to value ratio. It had been breaking out. Now we're starting to pull back. We're going to keep watching this. Mid caps also saw a decline in the growth to value ratio. So even though it's been looking a little better in the longer term, we'll be watching this to see if we see more of a change in the environment. And we did pull back with S&P growth to value as well after it had been showing some real improvement. We also saw a bit of a pullback when we look at discretionary versus staples with our ratio down on the bottom. It had been showing some signs of improvement, but now we're going to keep watching this. Here's our trend where we were climbing above the moving average after Monday. Now we're starting to go back below the moving average. The green line is on top, so we're positive, but we did drop down below 40, and we saw the red line really coming up. Here's the short-term chart. We're also dropping below the moving average, and the green line is coming down. We are continuing to see a couple of major days, or we're seeing a number of days with major volume over the last few trading sessions. So volume is really starting to pick up. Here's a look at sentiment where we didn't really move all that much with the Ulcer Index. With the down day, and I drew a trend line in here because we've been seeing a series of higher lows here with the VIX that started right about the beginning of December or so. And it looked like the VIX was really starting to fall, but with the decline that we saw on Tuesday, it picked back up with the line chart as well as the bar chart. With the down day, we also saw the VIX of the VIX, or the volatility of the VIX, really pick up as well. And we're starting to turn back up with the momentum of the VIX right now, that where the MACD had been going up. It looked like it was crossing over negative. If we see more weakness, this is probably going to turn and continue to go up. The equity put call ratio did go up based on the daily chart, and we're starting to turn back up based on the 5-period chart. So that's negative. And we were up into the very lower end of this red area with the skew index, and now we're dropping down from that. Maybe this is part of the big move that the market was expecting, and that ended up being to the downside, at least this time. The other times we saw this really spike up, the market kept going higher. This time it actually ended up going lower. We'll keep watching this chart to see if it gives us another signal. If we continue to fall, the skew index will probably continue to fall as well. Our advanced decline lines, not an awful lot of damage here. We rolled over a bit with the advanced decline line based on price and volume, but they're still holding up for right now. We saw a little bit of an expansion of the new lows and a contraction of the new highs. We're rolling over a little bit with our 5-period. We're still kind of trying to go up here with our 10-period. We're still positive with the advanced decline ratio. Even though it did decline, we're still above 0. Accumulation distribution did turn down, but it's still above the moving average. We did decline, and the moving average here is starting to roll over with the Chaikin money flow. And we did decline with the Chaikin oscillator. So we turned down with the common stock for the NYSE. When we look at the advanced decline line studies, turned down with the S&P, the mid caps, and the small caps are showing a little bit more weakness now. Here's our daily chart, and I've gone back to the 2-year version here because we've dropped below this trend line. This was kind of the first area of support, and we blew through that. So for right now anyway, we're below it. Now, we fell through this before. We were able to recapture it. Now we closed below it, and we're trying to see, is that going to develop into something more significant? We may have overdone it on a 1-day basis when you compare Monday to Tuesday, where we see the rate of change was pretty severe to the downside. Here's the Stochk RSI, which after Monday was extreme positive. Now it's already starting to get extreme negative. We turned down with our 20, 50, and 200 period moving averages. We're still positive, but we did decline with the force index. And we're not extreme in the short term with our stochastics. We're turning down, but still extreme in the intermediate term. And we're rolling over, but still extreme in the long term. We're no longer extreme with our standard deviations chart. We're still above the midpoint. So we're pulling back, and we're right on the border between the +1 and +2 standard deviations channel. This is the next area that we're watching. Now that we dropped below that trend line, I'll be really focusing on this chart. This is the 20-period moving average, and so far we still are above that. If we continue to fall, this has provided some support recently. We'll see if that ends up happening again. And here's another kind of similar chart, the 20-period simple moving average of the open, high, low, close. We're coming in right to the top part of this little mini rainbow. Intermediate term, we're still positive with the balance of power. We've turned over to a lighter shade of blue with the go, no-go system. We've come down with the highest high value, but we're still above the midpoint. The TTM squeeze has turned to a darker shade of blue, but it's still positive. And we actually went up with the ease of movement. That's kind of interesting. And we're pretty much flat now with the Arun. We have the green line coming down. The red line's also coming down. That's why we're going flat here. We're still positive because we're above 0 with the oscillator. And we're just on the verge of positive here with the S&P McClellan oscillator. It did decline. We're also keeping an eye on these longer-term negative divergences that go back to late 2023. So we're still going up for right now with the summation index based on price and volume. If we drop below 0, that will turn the summation. If we drop below 0 with the McClellan oscillators, then that will turn the summation index negative. The NYSE McClellan oscillator did drop below 0, so that's showing a little bit more weakness. So we're just barely starting to turn down based on price and volume, even though it's really hard to see that. It still looks like it's going up. We turned down with the Swenlin trading oscillator based on price and volume, but we're still above 0. We're starting to roll over below the moving average with the PMO. We're still looking positive based on price and volume, though. And we did see a decline in the PMOs that are rising. We're turning down with the buy signals, but we're still going up with the PMOs above zero. We switched from being positive over to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. And we're starting to roll over below the moving average with the slope oscillator. This is our shortest term oscillator and usually the touchiest. We're also starting to cross back below the moving average with the MACD. So with all of our different oscillators, where they had been looking more positive after Monday, now they're starting to look a little more negative. We're still above all of the lines plotted here on our moving average tree. And we declined. We're just a little bit above 70 with the bullish percent index. If this drops below 70, that's an official sell signal, and that would turn things more negative. But we continue to go up with the NYSE bullish percent index. It was little changed, but it didn't see a lot of weakness either. Where the NASDAQ 100 bullish percent index did decline, but it's still above 50. We're actually still looking positive with the money flow index. We're looking a little more negative with the ultimate oscillator, but we're still above 50. The vortex is still on top of the green line, and it flattened out. And we're no longer extreme with the RSI based on 9 periods, but we're still above 50. And we're also still above 50 based on 14 periods. On balance volume did decline, but we're still above the advancing moving average. When we look at the stocks above their 20-period moving averages, it did decline with the down day. We're also watching to see if this negative divergence is going to come back into play. We declined with the 200-period moving averages and the 50-period moving averages studies. So we're wondering, is this going to develop more into a negative divergence? The Copic curve still remains negative. The Sean trend meter, after being extreme, has dropped back down to just regular extreme now. We did see a little bit of weakness with the Heiken Ashi with the dark colored candle. We're actually turning negative now with the Kegi. You can barely see that, but it's turning to red. The Renko chart, it's thinking everything is just hunky-dory. It's still positive, and we're seeing a little bit of weakness with the 3-line break. We did come down below the trend line here, and we closed below it. Now, we closed down below that before. This was the day before NVIDIA reported, and then we saw that huge gap up. Now we're wondering, is the market going to come down and try to fill this gap at some point? And that's right around where the 20-period moving average is at. And then just because we're going down, I readjusted this. These are possible Fibonacci retracement levels. If we've topped out for right now and we start to come down, we'll be watching these different levels if we get close to them. And then we're also coming up, we're about a week away from a new 50-day cycle. As I point out in other videos, I don't use this to make decisions. This is more just for information, where the last signal was generated on January 2nd and we were negative, but then everything turned positive. We're wondering if that's going to have some kind of an effect this time. And then this is the weekly chart where now we're back down below this pivot point. Now we got a little bit above it back in 2021 before coming down. So that's why we really want to pay attention to this, where back in 2023, we hit that turn and went the other way. So we'll just see if this is going to end up being the long-term overhead resistance that was causing us some concern. We're still extreme positive with the 150 and 200 period moving averages. We're still looking okay with the Keller market model on all the different indexes and time frames. We saw a lot of red in Tuesday's session with the S&P dropping below 5,100 and a lot of damage done in the NASDAQ early on. And the equal weight is still holding up a little bit better than the weighted S&P 500. So we saw our ratio going down as a lot of the weakness was in the mega caps. And the Dow has now dropped below this pivot point, but it's still above its 50-period moving average. We're turning negative now with the Elder's Impulse system, looking at the diamonds. And we did see a drop, but we're still above the pivot point with the NASDAQ. And we're also above this pivot point with the NASDAQ 100, but we're turning negative with the Elder's Impulse system for the QQQs. And we're dropping back more negative on a momentum basis with the NASDAQ 100. We had been crossing positive above the moving average. After Tuesday's decline, we're now crossing below it. You could make a case for a negative divergence. And then if we are topping out and continuing to go down, this may also develop into another negative divergence. This is the longer term chart that we've been watching. We're dropping below this longer term ratio now. This is the NASDAQ 100, which is growth, compared to the Dow, which is considered value. And this is what the bearish folks are really honing in on here, because we came up to this level in 2021 and then we went into 2022. We were able to get slightly above it. Now we're starting to drop down right to the previous reading. The small caps, kind of disappointing, just more or less chopping sideways. When we look at the S&P index, we switched to neutral for the Elders Impulse system for the small caps. And we're not really doing that great now with the Russell 2000 small caps. It's coming back down into prices where we've been before. We're still above 50 with the RSI. We're still in a longer term uptrend, and the momentum continues to be positive for now. The mid caps also saw a pullback, and enough kind of to fill in this gap that we saw from Friday to Monday. And we switched to neutral for the Elders Impulse system for the mid caps. This is another ratio that I've been keeping an eye on. This is the QQQs, which is the NASDAQ 100, comparing it to the IWM, which is the Russell 2000 index. We've been coming up to this ratio as well, and now we're starting to drop down from that. We want to keep an eye on this. If this continues to fall, that would be longer term negative. And here's a look at Google, where it's still dealing with its 200-day moving average. And it actually fell down below that. And let's see, 130. Yeah, it actually closed it closed right on its 200-day moving average. So that's a pretty significant level. Apple is also seeing some weakness lately, not enough yet to generate a death cross here. This is just a 50-day moving average and a 200-day moving average, simple moving averages here. The longer we stay below this, we might end up seeing this crossover negative. And then Tesla, which has been looking more negative lately as well, is also in a shorter, more intermediate term downtrend. The FANG index did decline after coming off of setting all-time highs. The financial sector was up, not by very much, but it was up on the day. New York Community Bank jumped up 17.95%. I guess that's a pretty big move when you're under $3 a share. The dollar was down just a little bit, but we're still above the moving averages. Dollar strength could be some weakness for stocks. Then looking at bonds, we were down with the 10-year yield and we were up with the 10-year based on price. And so usually on a down day like we saw, we would have seen interest rates going up, but they actually went down. Looking at our growth to value, we are seeing some weakness when we look at the Qs compared to the S&P. Discretionary is back under the moving average compared to the S&P, and large cap growth compared to large cap value is also dropping below the moving average. So we're seeing some weakness in the large caps, mid caps, and small caps, but we're still trying to hang out, at least with the mid caps and small caps, above the moving averages. We're still looking positive here. Now, this is a longer term indicator, and it takes longer for this to shift. When we look at the highs minus the lows, take a 5-period simple moving average of that and spread it across the broad market. And we're still looking positive here with our 10-day average of the S&P 500 highs minus the lows. This is also slower to actually react to what's happening. So what's our outlook for Wednesday? We're positive, and for right now, it looks like we're just having a pullback. We're back below that overhead resistance. That's why I never changed it to support. We weren't really above it long enough. And we are possibly dealing with a period of weak seasonality. We're going to get the MBA Mortgage Applications Index. We get that every week. The ADP employment change and the JOLTS job openings. So we're going to get some employment data. And then wholesale inventories will be coming out. We want to keep an eye on the geopolitical events. It's what goes on in Washington, D.C. is pretty much portrayed as theater on Wall Street. They have friends on both sides, so they don't really care if it's Republican or Democrat. But they don't really pay attention to it. It's when there's some kind of a policy change that really affects the market. And so they really don't pay attention to that. And then they only pay attention to geopolitical events when it seems to be pop news, like the start of the Israeli war, something happening that usually comes into the news. Everybody's talking about it, and then it goes away. So, all right. Then we are going to get the employment situation report in Friday's session. Here's the new look at the calendar, giving you the forecasts and what the previous readings were. And I've tried to highlight the session for Wednesday. Seasonality, and this didn't turn out very well. We're neutral to negative We're actually flat negative when we look at the NASDAQ. I don't know how this chart didn't really turn out quite right there. So seasonally, March 6th is not necessarily a positive day, where we see some weakness even during an election year with the green dashed line actually going down. It'll be the 4th trading day of the month. We're also potentially entering that time of some seasonal weakness. We also see that on this chart. That's the black line. Wednesday is the most negative day of the week. And then according to Tom Bowley's research, we're beyond the positive time now. Now we're entering more of what his research could suggest is more of the weak time. So our warning signs, growth may be showing signs of weakness. We did see a pullback pretty much across all the different measures that we follow. The equity put call ratio, I had to put it back on this slide. It's now starting to go back up. We're still looking at some negative divergences with our S&P 500 oscillators, the McClellan oscillators and summation indexes, small and mid caps from the S&P, and discretionary to the S&P, as well as the transports are just not doing well. So I haven't even been showing that chart. The Copic curve continues to be negative, and the momentum for the NASDAQ 100 is turning back negative, and we're also entering a time of potential seasonal weakness. Positive signs. The parabolic SAR is still positive for right now. The vortex is still positive. Small and mid-cap growth, they did show some weakness, but they're still working off of seeing some real strength last week. And the financial sector continues to be positive. So our conclusion, we're positive, but for right now, it looks like a pullback. We're below that overhead resistance, and we're possibly we are coming into weak seasonality. Whether the market's going to follow that or not, that's the variable. And that's what we're watching in the short term. We're still looking a little extreme in the intermediate term, but now we've dropped back down below that overhead resistance. In the long term, we're still positive, but we're looking overbought with our 150 and 200-day moving averages. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.